Hello viewers, welcome back. Welcome back to our DCF valuation modeling course. We are so excited to be sharing this course materials with you. As you can see from our first video, we've directed you where to go so that you can be able to download the course materials. They are within our Telegram channel, where you can find the template that we are going to use from these tutorials, but as per now we haven't uploaded it there. So maybe we finish this, when we finish this chapter we shall upload that there, and we shall be able to see some of those things from that point. So what we are going to look at now, we are now going to move into the model building. We are going to move into the model building, and we are going to look at the processes that we supposed to go through as far as we finalize some of these things that we have in place. So it is very important for everyone working in finance to understand how to build a DCF model the right way. And in fact, we are going to start with the compact discounted cash flow model, or the DCF model. So that's what we are going to start with. It is really important to know how to construct one of these compact or simple DCF models quickly, for a couple of reasons. First of all, one of these simple or compact DCF models can really help us learn the main features of the DCF model without getting distracted with some of the complexities within the other full DCF model, because we know that these simple DCF models, they actually help us to get the picture of what we may be looking at. But now, the other full model, actually you find it has so many things that are going to be new to some of you guys, and you may find yourself a little bit confused. So when we start from the simple DCF models, they will actually give you the picture of how the end result will look like. So the other place where these compact DCF can really be helpful is that they can really help in situations that require some quick analysis. The quick analysis in terms of someone wants maybe to do some ratio analysis, someone wants to use maybe a common sized income statement to try out and do some analysis. So these simple DCFs will actually help us. But don't worry, because in this course we are also going to build a full DCF model, and that full DCF model, it is going to have a lot of complexities. But for now, let's dive in and take a look at what we need to know in order to build this compact model, because we need to know the things that are within the model itself. So let's now try to move ahead and think about what DCF models are and how they work. It's fair to say that we use DCF models in order to value businesses. In fact, the business value itself depends on the quantity and the timing of the expected future cash flows. In other words, the value of any business is within the future cash flows they anticipate to receive, taking consideration the timing of those cash flows. In fact, we can really think about a business as something which generates a number of future cash flows. And once we take all of these cash flows, the future cash flows, and we discount them back in time to arrive at a present value. In other words, since we anticipate that we are starting the business to make profit, and those profits are going to come in the future. So the thing is, we are trying to focus a little bit more on the cash flows that we will receive in the future. But at the same time, we need to look at the timing. In other words, since they are going to come in the future, we need to discount them back to know what is their present worth. And the reason as why we are doing it is because we are valuing the business today. But the business itself, it only anticipates to receive some cash flows. Remember, these cash flows, they may be outflows or inflows. In other words, the business is spending and it is also earning. So if they are expecting inflows to come in, so what we need to do is to make sure that we discount those cash flows back to their present, so that we can use their present value to get the value of the business. Because the value of any business is the present value of its future cash flows, and that's how we do business valuation as far as DCF techniques are concerned. So now remember, we've said that these cash flows are going to be coming in a given period of time. You may say that we anticipated that in year one we are going to get 10 million US dollars. In year two we might get maybe $15. In year three we may get maybe $25, depending on our projections that we did. But now, since those monies are coming in at a different intervals, they are coming in a different timing, what we need to do after getting the present value of their respective timings, we make sure that we add all those discounted cash flows and we effectively get the value of the business. Remember, if in year one you are receiving 10 million, the question is, what is, if I'm valuing the business today, let's assume today is year zero, how much will that be? If someone says I'm going to give you 10 million today, and the other person gives you maybe 12 million at the end of this year, so the person is going to be asking, how much can the 12 million that I'm receiving in the future be now? The only way to get that value is by discounting. So if someone is receiving that money in 2 years' time, the issue is, how much is it now? The getting that now value is what we call the present value. So, and that present value is gotten by discounting those cash flows. So after discounting those cash flows, we sum them up, and the value is going to be the total value for the business. So what we are really doing is we are converting all the future cash flows to their present value, and their present value is what we call the present worth. In other words, the equivalent value of those future cash flows today, that's what we call the present value, and that gives us the value of the business. Now let's think about something else. Let's think about some really important dates, especially when we are building DCF models. There are some dates which are very important, because we've been talking about receiving money in 1 year, receiving money in second year, receiving money in third year. So the point is, which dates are those that are important to us, especially when we are doing DCF models? So in fact, there are two critical dates that we always have to consider in these models. As long as you are using DCF technique to value the business, there are two important dates that you need to actually take into consideration. One, we need to understand the timing of these cash flows. So the cash flow timing is really very important. The timing of these cash flows is really important. And the second one, we have also to look at the valuation date, the date when we are doing the valuation. In other words, the date that we are carrying out the valuation. Those two dates, they are actually very important. So if we first think about the future cash flows, if we try to think about the future cash flows, and these future cash flows, they're actually the amounts that we anticipate to receive in the future. In other words, if you look at this point here, this first one, the first concern, this one as our first concern, if you look at this area here as our first area of concern, the point here is that we need to make sure, the point from this perspective, we need to make sure that we need to make sure that we know the dates within each year when these cash flows occur. So what do we mean by knowing the dates at which these cash flows are going to occur? Knowing the dates at which these cash flows are going to occur, it means we need to understand whether these cash flows are occurring at the beginning of the year, whether they are at the beginning of the year, or they are in the mid of the year. Are we receiving these cash flows in the mid of the year, or are we receiving them perhaps at the end of the year? Are they at the end of the year? That's very, 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 very important. And the reason that's why these are very important is because we need to know so that we can plan well. Because you may be suggesting that I'm going to buy maybe a certain machine in year 1, but you find when these cash flows are actually starting to come in year 3. So which one are you going to be using to purchase some of those machines that you are suggesting? So now, for the purposes of simplified compact model, we are going to assume that these cash flows are occurring at the end of each year. This is what I want us to actually put in focus. For now, for these simple methods as we are talking about them, we are going to assume that these cash flows are actually coming in at the end of the year. That's what we are going to assume for now, that we are receiving these cash flows at the end of the year. Now, when we look at the full DCF, we are going to talk about how to control the model when these cash flows occur at different times. Like, for example, in the middle of the year, or maybe they are coming after maybe year quarter 1. In other words, because there are those projects, let's say for government project, you are constructing maybe a certain building or a certain warehouse, and they are telling you, for us, we are going to pay you money at the start. We give you some portion at the start. We may give you the some portion at the end of the year, and maybe in between there, provisionally, if it is actually necessary. There are those that are projects that you are going to have, and they will take maybe long time for them to be giving you the inflows. Maybe for government, they have taken long to pay. So we need to understand, but for this simple, because we are going to look at a simple DCF. This simple DCF, we want to assume that these cash flows are actually coming in at the end of the month. In other words, we don't need to worry about the timing. But when we look at the full modeling course, or the full DCF full model, we want to look at those three assumptions: when the cash flows are coming in at the end of the period, at the beginning of the period, or in the mid of the period. So now let's think about these two ideas in that format. So that's what we are going to assume as for now. So the other thing now we need to look at is this item here, the valuation date. We are done with this. We are now done with the timing of the cash flows. We've said for now we are going to assume that they are coming in at the end of the period. But for now, let's try to look at the valuation, this valuation date. Now, this is the date that we set and we use it for the valuation. In other words, this date is going to actually be set. We just set it and we only use it for valuation. So we are going to just use it for valuation, but it's us who set it, because you may decide that I'm going to start the valuation in maybe after 5 years, or maybe I'm going to start now, but I will proceed up to maybe 5 years from now, or I push it 5 years backwards. So it depends, because these financial models, they are going to be done by experts. First of all, you need to have the information before you actually come to start doing some of these analysis. So we always set the date because we are the ones preparing the model. So it is the date that we are going to set for our valuation. So when we refer to a present value, that present value is as of the valuation date. In other words, if we say that we are going to start valuing in this year 2024, the point here is that we need to make sure that at least the present value for us, we are only looking at it as 2024. If you are projecting, if you are forecasting a project of 5 years with a lifespan of 10 years, 5 years, you look at 2024 as your year of forecast. In other words, the valuation date. So effectively, all the cash flow quantities are going to be adjusted or discounted back to this valuation date. In other words, if you say that in 2024, that's our valuation date, maybe let's say June 1st, then this June 1st is going to be our valuation date, meaning all the cash flows we anticipate, we shall start forecasting the cash flows of 2025. We go to 2026, 2027 up to maybe 2030. So all these cash flows, they will be discounted back to 2024. Here is going to be discounting. But when we are projecting from 2024 to 2025, what we are doing there is what we call compounding. In other words, we are forecasting in the future. But this discounting is coming from the future to the present, meaning this will be our present value. All the present values will be in that year 2024. So that's what we are discussing here, that all our future cash flows will be discounted back to their present value, and the present value will be that date of valuation. So hope we've been able to understand some of the key things that we've looked at. But now, what we are going to look at in the next video, we are going to dive in and take a look at the mathematics behind that explanation we've been talking about. And we see exactly how that works. So that computation that we are going to look at is what we call the time quantity of money, or the time value of money. So the next video that we are going to look at is going to be looking at the time value of money. So those are the things that we are going to look at from that perspective. So let's see you in the next video as we are looking at the time quantity of money.